day, everyone. Today I am going to discuss about the final topics on capital market. So the first topic will be the mergers and acquisitions. So our learning objectives are first describe the different types of mergers and acquisitions, the horizontal, vertical, and conglomerate. Second, analyze the strategic rationale behind M&A transactions. And third, identify the key steps involved in the M&A process, including due diligence and integration planning. So what is mergers and acquisitions? So a merger is a transaction of two companies, usually of similar size, in which the shareholders of each of the two companies jointly own the shares of the company that arises after the merger. This is distinct from an acquisition where one company, the buyer, buys the outstanding shares of a target company, and the target company's shareholders receive the proceeds from selling those shares. So now, let's identify the different types of mergers and acquisitions, the horizontal, vertical, and conglomerate. First is the horizontal acquisition. Horizontal acquisitions, also known as horizontal mergers, refers to the process of consolidating market share by combining two companies operating in the same industry and offering similar products or services. An example of this is when Jollibee Foods Corporation, a leading fast food chain based in the Philippines, acquired Smash Burger, a burger chain based in the United States. So this acquisition allowed Jollibee to enter the American market and expands its presence in the burger industry. By acquiring Smash Burger, Jollibee gained access to a new customer base, increased its market share, and strengthened its competitive position in the fast food industry. So next is the vertical acquisition. So it refers to a situation where company acquires another company that operates at a different stage of the production or value chain. So for example, a company A is a clothing manufacturer that specializes in designing and producing apparel. In order to streamline its supply chain and gain more control over the production process, Company A decides to vertically acquire a textile mill. By acquiring the textile mill, Company A can now directly source and manufacture the fabrics needed for its clothing line. This vertical acquisition allows Company A to reduce costs, improve quality control, and have greater flexibility in its production operations. So the third one is conglomerate acquisition. A conglomerate merger is a union between companies that operate in different industries and are involved in distinct unrelated business activities. For example, imagine a technology company acquiring a food and beverage company. This type of acquisition allows the acquiring company to diversify the business portfolio and enter new markets. It can also provide opportunities for synergies and cost savings by leveraging resources and expertise of the different companies within the conglomerate. The second objective is analyze the strategic rationale behind M&A transactions. Mergers and acquisitions transactions are driven by various strategic rationales that aim to create value for the companies involved. So here are some common strategic rationales behind M&A transactions. First is market expansion and growth opportunities. So mergers and acquisitions play a crucial role in helping companies expand their market presence and take advantage of new growth opportunities. For instance, a company might acquire a local business in a foreign market to quickly establish a presence and gain a competitive edge. So second, diversification of products and services. So diversification through mergers and acquisitions allows companies to expand their range of products or services, reducing reliance on a single market or product line. For instance, a company operating in the healthcare sector might diversify its portfolio by acquiring technology firm specializing in healthcare analytics. This diversification not only reduces the risk associated with fluctuations in a single market but also creates opportunities for cross-selling and enhances the overall resilience of the business. Third is achieving economies of scale. Consolidating operations through mergers or acquisitions enable companies to achieve economies of scale, which is essential for improving operational efficiency and reducing costs. So for example, when two manufacturing companies merge, they can optimize production facilities, leading to cost savings through bulk purchasing, shared technologies, or more efficient resource utilization. This increased efficiency allows the merged entity to produce goods or services at lower cost per unit, making them more competitive and enabling them to adopt competitive pricing strategies. So fourth is acquiring new technologies and expertise. So mergers and acquisitions provide companies with access to new technologies, intellectual property, or specialized expertise that can significantly enhance their competitive advantage. So for example, a company aiming to stay ahead in the digital landscape might acquire a startup with advanced data analytics capabilities, or AI-driven solutions. Fifth is eliminating competition and strengthening market position. So mergers and acquisitions are often driven by the desire to reduce competition or increase market dominance. So for example, a merger between two major players in a specific sector could result in increased market dominance, allowing the merged entity to dictate pricing strategies, set industry standards, and control a larger share of the market. This consolidation often leads to greater bargaining power with suppliers and more control over distribution channels, ultimately reinforcing the company's position within the market ecosystem. The third objective is to identify the key steps involved in the M&A process, including due diligence and integration planning. So here are the key steps involved in the M&A process. So step 1 is just strategic planning, target identification, and initial research. The first step in the acquisition process is to identify the target market or potential buyers. This involves assessing whether the target aligns well with the existing business and determining any necessary changes for a successful integration. For example, let's say a clothing company is looking to acquire a shoe manufacturing company. The clothing company would assess whether the shoe manufacturer's products and target market align with their own business. So they would also consider any necessary changes or synergies that would be required for a successful integration. In order to finance the acquisition, the clothing company may secure a loan or issue additional shares. It is crucial for the clothing company to have a funding plan in place before committing to the acquisition process. Step 2 is the offer. The letter of intent, term sheet, heads of agreement, or the heads. So the second step in a deal is to establish the key terms, such as the structure, timing, price, and conditions, which are usually outlined in a non-binding document called a letter of intent or heads of agreement. Example: after discussing the initial details of the acquisition, the parties involved agreed to proceed with the letter of intent. This document outlined the proposed purchase price, the timeline for completing the transaction, and the conditions that needed to be met. Additionally, additionally, exclusivity clause was included to grant the buyer exclusive rights to negotiate with the target company for a period of 90 days. This letter of intent served as a solid starting point for further negotiations and set the groundwork for the deal. So step 3 is due diligence. So due diligence process is when the buyer gathers information about the target company to ensure that the acquisition is a good decision and that the terms of the deal are reasonable. So for example, if the buyer discovers significant financial liabilities during due diligence, they may request a lower purchase price or ask for indemnities to protect themselves from future risk. Fourth is the legals. During the legal phase of a transaction, the lawyers representing the parties involved will work on drafting and negotiating the terms of the sale and purchase agreement. This agreement contains the agreed upon terms of the deal, including warranties and indemnities to protect the buyer. Example, during the legal stage of a business acquisition, the lawyers representing the seller and buyer collaborate to draft and negotiate the terms of the sale and purchase agreement. They discuss and adjust the terms based on the findings of the due diligence process. The agreement includes warranties to assure the buyer of the condition and accuracy of the assets being sold, as well as indemnities to protect against any identified concern. So step 5 is completion, closing the deal. The closing stage of a transaction involves extensive planning and coordination to ensure that all necessary paperwork is prepared and signed by both parties. Previously completion meetings with all involved parties and their legal teams held for the signing and exchange of documents. So step 6 is post-closing and post-merger integration. After the completion of a deal, there are several tasks that need to be accomplished by the parties and their legal teams. So these tasks may include filing documents at company's house, paying stamp duty on shares, and issuing notices to customers and suppliers. Once the deal is closed, the focus shifts to post-merger integration. Step 7 is monitoring and evaluation. Post-acquisition audits are commonly employed by businesses to evaluate the effectiveness of an acquisition. They involve assessing the M&A process, gauging the integration success, and monitoring the fulfillment of warranties, indemnities, and other terms in the acquisition agreement. So, this helps identify potential claims and ensures compliance with obligations. The second topic is investment banking. So the first learning objective is to explain the role of investment banks in capital markets, including underwriting, mergers and acquisitions advisory, and financial restructuring. So, role of an investment bank in the capital market. Investment banks serve several purposes in the financial and investment world, including underwriting new stock issues, handling mergers and acquisitions, and acting as a financial advisor. So first is underwriting new stock issues. Investment banks play a key role in connecting companies with investors through initial public offerings. So they help companies go public by underwriting new stock issues where they agree to buy a certain amount of shares from the company to resell on the stock exchange. For example, Company Y decides to go public and seeks funding by issuing new stocks. An investment bank steps in to underwrite the stock offering, agreeing to purchase a set number of shares from Company Y. So the investment bank then sells these shares to investors through a stock exchange, helping Company Y raise capital for its business. Next is mergers and acquisitions. So investment bankers play a significant role in mergers and acquisitions. Similar to initial public offerings, they possess expertise in assessing the value of potential acquisitions and determining a fair price. Next is financial advisory roles. Investment bankers provide various advisory services to their clients, including assistance with initial public offerings and advice on going public or raising capital through alternative methods. They offer comprehensive guidance on financing matters to corporations. The second learning objective is to analyze the different financial products and services offered by investment banks. Investment banks offer a wide range of financial products and services to meet the needs of their clients. Here are some of the key offerings. First is mergers and acquisitions. Investment banking offers services related to mergers and acquisitions, which involve combining companies and assets through financial transactions, such as acquisitions, consolidations, and mergers. Second is equity research. In equity research, professionals investment banking analyze investment opportunities and provide recommendations to clients on whether to buy, sell, or hold their investments. Their goal is to offer guidance and insights for clients' investment decisions. For example, an equity research professional may analyze a specific company in the technology sector. They would assess factors such as the company's financial performance, market trends, and competitive landscape. Based on their analysis, they may recommend that clients buy the company's stocks if they believe it has strong growth potential. Conversely, if they find concerns about the company's future prospects, they may advise clients to sell or avoid investing in the stock. Third is corporate finance. Investment banks provide corporations with valuable financial guidance, assisting them in optimizing their capital structure, restructuring debt, and managing financial risk. Their services aim to improve shareholder value and help clients achieve their financial objectives. Fourth is trading and sales. Investment banks participate in trading various types of assets such as stocks, bonds, commodities, and derivatives. For example, investment bank like ABC Bank may engage in trading activities by buying and selling stocks on behalf of clients. They may also trade in bonds, commodities, and derivatives such as options or future contracts. By actively participating in these markets, the banks helps ensure there is enough liquidity and facilitates the smooth execution of trades. This allows clients to access and invest in different asset classes and manage their portfolios effectively. Fifth is research and analysis. Investment banks have research analysts who offer recommendations and insights on different sectors, industries, and specific companies. Their reports and analysis assist clients in making well-informed investment choices. Sixth is asset management. Investment banks have asset management divisions that handle investment portfolios for both institutional and individual clients. These divisions provide various investment products such as mutual funds, hedge funds, and private equity funds. Seven is risk management. Investment banks support clients in handling different financial risks, including market, credit, and operational risk. They offer strategies, assessments, and solutions to hedge and minimize risk, safeguarding clients' interests. The third learning objective is to identify the valuation techniques used by investment banks to evaluate companies for M&A transactions. Investment banking valuation techniques rely on financial modeling, which enables investment bankers to analyze a company's financial performance and make informed decisions. Financial modeling involves using spreadsheet software, data analysis, and statistical tools to forecast future revenues, expenses, and cash flows. Discounted cash flow or DCF analysis. The DCF analysis is a commonly used method in investment banking to determine the value of a company by estimating the present value of its future cash flows. For example, the DCF analysis can be used to evaluate the value of a manufacturing company by estimating its future cash flows and discounting them back to the present using an appropriate discount rate. The analysis takes into account factors like inflation and potential to earn interest. This helps determine the company's current value and assess its investment potential. Leverage buyouts. LBOs or leverage buyouts are investment transactions in which a company is acquired using a large amount of borrowed money. This type of investment banking valuation technique involves assessing a company's ability to generate cash flows that can be used to repay the debt used for the acquisition. For example, a private equity firm acquires a manufacturing company by borrowing a substantial amount of money. The firm then uses the company's cash flows to repay the debt over time. The success of the LBO depends on the company's ability to generate enough cash flow to cover the debt payments and ultimately provide a profitable return on investment for the private equity firm. Comparable Company Analysis or the CCA. CCA or Comparable Company Analysis is a popular valuation method in investment banking. It involves evaluating the value of a company by comparing it to similar companies in the market. For example, imagine a technology company XYZ Incorporated is planning to go public. To determine its valuation, investment bankers would analyze other publicly traded technology companies that are similar in size, industry, and financial performance. They would examine metrics like earnings per share, price to earnings ratios, and enterprise values of these comparable companies. Precedent Transaction Analysis or PTA. PTA is an investment banking method used to determine the value of a company by comparing it to previous transactions involving similar companies. Next is relative valuation methods. Relative valuation methods are commonly employed by investment bankers to determine the value of a company by comparing it to similar companies in the market. So for example, if company A has higher earnings per share and a lower price to earnings ratio compared to company B and company C, it might indicate that company A is more profitable and undervalued in comparison. This information can help investors and analysts assess the worth of company A relative to industry peers and make informed investment decisions. The third topic is portfolio management. The first learning objective is to explain the process of constructing and managing a diversified investment portfolio. So, building a diverse portfolio is essential for long-term investment success. Investment funds can simplify the process of creating a diversified portfolio. So, here are the processes of constructing and managing a diversified investment portfolio. First is to determine your investment goals and risk tolerance. Before you begin investing, it is crucial to assess your investment objectives and risk tolerance. Consider factors like your comfort level with risk, your investment goals, and whether you are investing for the long term or a short term goal. Next is choose asset classes to invest in. Diversification in investing involves spreading your investment across various asset classes like stocks, bonds, real estate, and commodities. This strategy helps to minimize the overall risk of your portfolio by taking advantage of the different characteristics and behaviors of each asset class in different market conditions. Next is select investment funds for each asset class. Investment funds provide a convenient way to invest in various asset classes. There are different types of funds such as mutual funds, exchange-traded funds, and index funds, each with its own benefits and drawbacks. Next is consider fees and expenses. When investing in investment funds, it is important to consider the costs involved, such as management fees, operating expenses, and transaction fees. These fees can accumulate over time and impact your investment returns. Monitor and rebalance your portfolio. So, it is important to regularly monitor and adjust your investment portfolio to maintain diversification. Monitoring helps track progress towards your investment goals, while rebalancing involves selling overperforming investments and buying underperforming ones to maintain a balanced portfolio. The second learning objective is to evaluate different asset classes such as equities, bonds, alternatives, and their suitability for different investor risk profiles. Different asset classes such as equities, bonds, and alternatives have varying characteristics and risk profiles. Here's an evaluation of these asset classes and their suitability for different investor risk profiles. Equities. So, equities have the potential for high returns but also come with higher volatility and risk. They are suitable for investors with a higher risk tolerance and a longer investment horizon. Equity investments can provide growth opportunities and are often recommended for investors seeking capital appreciation. Next is bonds. Bonds are considered less risky compared to equities as they offer fixed income and lower volatility. They are suitable for conservative investors who prioritize capital preservation and regular income. Bonds can provide a steady stream of interest payments and are often recommended for investors with a lower risk tolerance. Third is alternatives. Alternative investments include real estate, commodities, hedge funds, private equity, etc. These asset classes have unique risk-return profiles and can provide diversification benefits. Alternatives are suitable for sophisticated investors with a higher risk tolerance and a longer investment horizon. They can be used to reduce portfolio volatility and potentially enhance returns. The third learning objective is to analyze and select investment vehicles such as mutual funds and ETFs for portfolio construction. An investment vehicle is a financial instrument or account that helps investors generate returns. It encompasses various assets such as stocks, bonds, and mutual funds and can be either high or low risk. It is an essential component of an overall investment strategy. There are several types of investment vehicles. Most investors focus on a few key types that best fit their current financial situations and goals. The diverse investment vehicles list below covers the kinds of vehicles you should know about and how they work. First are stocks. A stock is an ownership stake in a company. You can buy and sell stocks in units called shares. Your stake in the company depends on the type of stock and how many shares you own. Second is exchange-traded funds or ETFs. An exchange-traded fund is a type of investment fund that pools investors' money and distributes it across various investments. Third are bonds. A bond is like a loan where you lend money to an organization or government. They issue bonds to raise funds, and when you buy bonds, you become a lender. In return, you receive interest payments and get your money back when the bond matures. Fourth is target date funds. Target date fund is a mutual fund designed for a specific retirement year. The fund manager adjusts the allocation of assets to optimize the portfolio for that particular year. Fifth is mutual funds. A mutual fund is a financial product that collects money from multiple investors and uses it to make investments such as stocks or bonds. The level of risk associated with the mutual fund depends on the specific investments it holds. Certificates of Deposit or CD. A certificate of deposit is a financial product offered by banks and credit unions. It requires depositing a fixed amount of money for a specific term during which the money earns a fixed interest rate. 7 is cryptocurrency. A cryptocurrency is a type of digital asset that uses encryption to secure transactions in a blockchain. It is decentralized, relying on a network of computers to validate transactions. While Bitcoin was the first cryptocurrency, there are now thousands of others. 8 is cash equivalents. Cash equivalents are financial instruments that can be easily and quickly converted into cash. To be considered a cash equivalent, a financial product must have a maturity date within 90 days. 9 is real estate. Real estate investing involves buying properties with the goal of renting or selling them for a profit. It requires capital and knowledge of the local real estate market. While it offers high profit potential, it also carries substantial risk. 10 is REITs. A real estate investment trust is a convenient option for ordinary investors to include real estate in their portfolios. REITs own income-generating properties and are traded on stock exchange. So what are the best investment vehicles? The most suitable investment options depend on various factors such as your life stage, financial goals, risk tolerance, and time horizon. It is important to align your goals with the appropriate investments. Consider your financial objectives and choose investments that are well suited to meet those goals. So for long-term goals like retirement and college funds, it is recommended to focus on investments with potential for growth. So one option is to use target date funds for retirement or a combination of ETFs and low-cost mutual funds to create a diversified portfolio. So for short-term goals, so when you have short-term goals like buying a home in the next 1 to 2 years, it is important to prioritize investments that are stable and won't decrease in value. Cash equivalents such as savings accounts or money market funds are the safest option for short-term savings. If you have a time frame of 3 to 5 years, you can also consider investing in a high-quality short-term bonds. So that's all. Thank you for listening.